was the last quiz, and based on following balance sheet. So we just want to make sure that fixed assets were used at 75% of capacity. So 500 divided by 0.75, 500 divided by 0.75, 66.67. There's capacity sales, right? There's capacity sales. But S1 is 500 times 10% growth, 1.1, 550. That is less than capacity sales, right? That means you don't have to increase fixed asset. This is 100. Then what? Then only those spontaneous ones will go up. So 50 times 1.1, 55. 60 times 1.1, 66. 80 times 1.1, 88. So if you add the right-hand side, then what? Using 55 plus 66 plus 80 plus 100, 309. So this is 309, right? And right-hand side is too crowded, so let's use green. This one times 1.1 is 11. This is notes payable, long-term debt, financial things, common stock, financial things. Only retained earnings, you add, what's going on? You add S1, that is 550, times profit margin 4%, 0.04, times dividend payout ratio 50%, so 1 minus 0.5 is 2.5. Then we have 550 times 0.04, 0.04. 0.04 times 0.5, 11. So 30 plus 11 is 41. So if you add right-hand side, 11 plus 50 plus 80 plus 120 plus 41, 302. So 309 minus 302, 7. So 7 is the answer. That's why if the answer is $1, enter 1, so 7. And then, oh, lots of people missed. 18 people missed. Not so bad, because we have 59 people, 59, 18. So 40 people got it correctly. That's a good news, right? So most of you are following me. That's good. But if you're missing this one, if you miss this one, then what? You have to really study more. So that is quiz. And I see that somebody's not showing face, Norma. And I see that And believe it or not, I told you that if you're late 1 minute, that's late. But strangely, there are still 1 or 2 people who are late by 1 minute. That's not good. Okay, that's final warning. Okay, then let's just continue our just progress.
Wait, Professor.
Yeah.
What would we do if S1 was greater than capacity?
That one we just did already. Yeah, that is just already covered. So please read the review. So that means you didn't review previous lecture notes, right? So please review previous lecture note. And since you asked, what you do is you have to calculate full capacity fixed asset capital intensity ratio, right? And then you multiply that to next year's sales, then you will get new net fixed asset, right? So that is good question, but that is already covered last class.
Okay, I'll just review. Thank you.
Yeah, please review that. And if you still cannot get it, then you can ask. So ask me what part you didn't get it. Yeah. So that is good question, but already covered. And then that is we did this. A 15-year 12% semi-annual bond sells for 1153.72. Then we can get return on debt. That is, I told you, cost of debt, right? Because now we are on the manager side, company side. So the other side is investor side. If investors require some return, then what? Then you have to provide them the return the investors require. Then what? And that becomes your cost, because you have to provide them what they require to get their money, right? They won't invest their money unless you give them their required return. So that becomes your cost. So that's why R&D is used both for return and also cost. Return for investors, that is cost for you to get their money. So in this case, you just calculate, in this case, why RD is actually YTM. YTM. What is YTM? Remember?
Yield to maturity.
Yield to maturity. That is actually RD. Okay. Yield means what? Return. So when you calculate investor's return, and there is a cost, but there is one more, I'll talk about that. So this one is extremely difficult problem in your grandpa's finance, because you have to calculate RD. So formula is like this: 1153.72 present value, right? Price equals 60, the first 60 divided by 1 plus RD over 2. This is semi-annual coupon. Plus 60 over 1 plus RLD over 2 squared, plus all the way up to 1060 divided by 1 plus RLD over 2, 60th power. Because, sorry, it's 15 years, so 30. So think about this. This is 30-degree polynomial. You cannot solve it by hand, right? So your grandpa's finance, they try to solve it by what? Trial and error. They just plug in a number and see whether the answer is close to 1153.72. But for you, with technology, it's a matter of seconds. So all you have to do is enter all the other numbers. So it's N is 30, 15 times 2, right? 15-year bond period is 30 period because semi-annual coupon. And don't forget to put negative here. Why? Because you buy this bond by paying money. That is negative, right? Cash outflow. You have to pay money to buy bond. Then you will get cash inflow, $6 interest into your pocket every 6 months, and $1,000 into your pocket at maturity. So those are all positive because money into your pocket. But this is negative because you have to invest cash outflow out of your pocket. So, and then you solve for IY. So,
Professor,
yeah.
how did you determine 60 and 1,000?
Oh, good question. Extremely good question. Actually, the payment 60 is from the formula coupon payment equals par value times coupon rate. So according to this one, par value, and besides, par value can be 1,000 or 5,000 or even 100, but generally it is $1,000. So in class like this, when there is no par value is given, don't forget that the assumption is 1,000. That's why you should not miss the class. Okay, we just agreed on about the price of the bond, par value bond, $1,000, right, to save time. So this is just assumption, okay? So $1,000 par value times 12%, 0.12, 120 per year, right? But this is semi-annual bond, so actually semi-annual payment equals 120 divided by 2, 60. That's why it is 60, right? And 1,000, as I said, is just agreed upon. Okay, we just assume that we are buying normal, ordinary bond. Generally, it is $1,000, and is 30 because 15 years times 2, twice a year. Thank you for asking. Yeah, that's why question is very important. Okay, because I didn't do it because this is actually what we did in 3 or 4. So just I assume you remember, but if you took 3 or 4, maybe 2 years ago, it's hard to remember. So that's why, yeah, that's a good question. Please make sure that coupon payment is par value times coupon rate. That is annual coupon. The semi-annual coupon is what? 120 divided by 2, right? So that's how you get 60. So 60 payment, 30 N, 1,000 future value. The present value should be negative. So using our technology, let me check. Good. So we have 30 N. By the way, as you know, the order doesn't matter. So just 1,000 future value. 60 payment and 30 N and 1153.72 should be negative, right? Plus minus, negative present value. And compute IY, 5, right? So you get 5. But extremely important, so I change color. That is what? That is, this 5% is periodic rate. just period, semi-annual. But don't forget that when we say interest rate, always per year, okay? Interest rate is stated in terms of year. So in other words, without saying otherwise, the interest is always stated per year, So these days, interest rate is 3%, that is what, 3% per year. So about 5% is 5% per 6 months, half year. That's why you have to multiply by 2. So all these 10%. That's very important, okay? That is, many people make mistake about that.
Can you repeat the answer? Why did you multiply by 2 again? Is it because it's saying semi-annual?
Check. So this the answer, 5% on the calculator, right? So many people just put 5%, that's wrong. The 5% is 5% per period. Period means what? 6 months, right? So actually 2 period is 1 year. So another 5% here. So actually 10% per year. So 2 period per year, right? 2 period per year. So another 5 plus 5 or 5 times 2, 10%. So that is RD, okay? RD is annual interest rate. So periodic rate times 2, right? RD. So, but you have to be very, very careful because now it's cost of capital, right? Cost of capital. Actually, cost, I told you, is what? After tax cost, right? After tax cost. So after tax cost is what? After tax cost is what? When the company pay interest, then what? The interest is tax deductible. That's very important. This tax season, you want to have lots of deductibles, right? The more deductibles you have, the less taxable income. So you pay less tax, right? So here, interest payment is deductible. So actually, they are paying less tax. There's tax savings. I told you that savings is what? Cash inflow. You save money, then there's actually cash inflow. So your after tax is not 10%. Actually, your after tax cost is less than 10% because of tax benefit. So this one. So interest is tax deductible. So after tax, don't forget that. Always this formula, after tax equals before tax times 1 minus t. Before tax times 1 minus t. Then it always works, whether it is interest rate or it's dollar, whatever. This formula is really simple, but lots of application. So after tax RD equals before tax RD times what? 1 minus t. Same thing, 1 minus t, right? So 10% is before tax, right? Then you multiply 1 minus t, then 6%. So this is the final answer. So after tax cost of debt is 6%. Before tax cost of debt is 10%. So you're actually paying 10%, but you get 4% back from the government because of tax deductibility. You pay less tax saving. So that you are saving 40%. So actually you are paying after tax 6%. So that's why companies actually borrowing money, because not only is cheaper than cost of equity, but also it makes even more cheaper, right? Why? Because of tax deductibility. So it's a pretty low cost financing if the amount is proper, right? But if you buy too much, if you borrow too much, then there's bankruptcy cost kicked in. So you have to be very careful. So this is 6%, right? The final answer. Then use nominal rate. Actually, we didn't calculate effective rate, we just 5% too. That means 10% is nominal rate, it's not effective rate, right? What is effective rate? You can use your technology. Second icon, nominal rate is actually 10%. Cash compounding per year is what? Okay, 2. I saw the sign, 2, enter. And compute. 10.25%. Effective rate is 10.25%. Right? But we just use nominal rate. Why? Because we when you do a project analysis, right? When we do project analysis, we just use 1, 2, 3. That's a 5-year project, and what? Cash flow is at the end of the year, like this, right? That's the assumption. Time value of money. Cash flow is at the end of the year. But in reality, cash flow can occur anytime during the year, right? So, this makes cash flow smaller in time value of money wise, because earlier cash flow is bigger than later cash flows. So if you discount these cash flows, if you use effective, it makes it even smaller, more smaller, right? Smaller. So just use nominal rate. Nominal rate, then just you can just alleviate the effect of making cash flow at the end of the year, right? Because if you make cash flow at the end of the year, present value will be smaller. Present value will be smaller than cash flow during the year, right? So we use nominal rate to just compromise cash. So we just usually put cash flow at the end of the year, right? So use nominal rate. If not, the calculation is extremely kind of tedious, right? If you just get present value each time the cash flow occurs, then what? Too tedious, right? So rather than that, just make cash flow at the end of the year, right? Then discounting should be smaller rather than effective rate is greater than nominal rate. So that's why. And also, flotation cost is small. Why? Because you may say that $1 million is not small, but compared to the size of bond issue, then that is small, okay, relatively speaking. So we ignore that. But if flotation cost is sometimes big, whatever the reason, then you cannot ignore, right? But generally speaking, compared to the size of bond, flotation cost is small, so we ignore that. So that's why.
You entered it on the calculator one more time?
Oh, sure. That's a very good question. Because this one is very important, highly likely to be on the exam or quiz, right? So all you have to do is, let's go back to here, okay? So second, clear TVM, $1,000 future value. And payment is 60, right? 120 divided by 2, 60 payment. And 30 period, 30 end. And 1153.72 should be negative, plus minus, right? You have to pay money. And compute for IY, 5. But that is, as I said, 6 months rate. But we have to calculate annual one, So 5 times 2, that's how to get 10%. But that is not the cost of debt yet, because we have to have after-tax cost. So 10% times 1 minus t is 40%. So final answer, 6%. Okay. Then that's cost of debt. The next one is cost of preferred stock. Preferred stock. And that is, again, from 3 or 4, but it's like preferred stock is, as you know, the dividend is fixed, stay the same. So you have DP means preferred, P means preferred, D means dividend. So DP, the same dividend forever. So what is the name of this cash flow? Anybody? What is the name of this cash flow?
Is it perpetuity?
Sure. Good answer. Good answer. Perpetuity. So what is the present value of perpetuity? Do anybody remember the formula? Present value of perpetuity. Present value of perpetuity. That is payment over I. Do you remember? Payment over I. And if we apply this one to preferred stock, payment is what? Dividend, preferred dividend. And I is no longer interest, it's more generally return. And return of preferred stock is RP. And in this case, return means also cost. That is RP is cost of preferred stock. Okay. Originally RP is return on preferred stock, but it is now cost of preferred stock. So we are solving for RP, right? So actually from here, RP equals, and actually present value is now price, right? Price.
Hey, Professor.
Yep.
What does the Q stand for in 10% Q?
Oh, good answer. Good question. Yeah, the Q means quarterly dividend. Q means quarterly, 10% quarterly dividend.
Okay.
Thank you for asking. Yeah. That is very good question. Yeah. And F means, this F means, any guess?
Flotation?
Good answer. Flotation cost. Flotation cost. As you know, flotation cost is cost associated with floating the security, in this case, issuing preferred stock, contacting investment bankers, printing preferred stock, printing prospectus, all those, cost, the flotation cost. And preferred stock flotation cost is not to be ignored or not negligible. So we include flotation cost. So here, present value, it means price. Price is what we call P. P is like this. Then for you to solve for RP, from this formula, RP is what? RP, cost of preferred stock equals what? from this formula?
P over DP.
Oh, the other way around.
Okay, GP over P.
Check, yeah, dP over P. dP over P. So that is this one. Alpha is dP over P, and N is net issuing price. So that is what? Price minus flotation cost. So that's the only thing that we adjust, because now we are calculating cost. The cost-wise, even though if you get 113.10, you have to spend $2 per share. So you have to subtract the $2. So net issuing cost, net issuing price, then what? 111.10. And this one is that 10% dividend rate. So it's like preferred stock, like bond. Preferred stock is hybrid of bond and stock, right? So dividend is like bond. So DP, preferred dividend, is par value times dividend rate. Right? It's like bond, right? Par value times coupon rate, same thing. Par value times dividend rate. So it's like bond, so it's the same dividend, like same interest, like bond, but like stock, there's no maturity, right? Preferred stock. So it's hybrid. Then par value, par means par value 100 times 10%, 0.1. That's how you get this one, 0.1 times 100. So par value times dividend rate, preferred dividend rate. And you have to be careful that there are two, one is price, 113.10, one is par value, right? So be careful. Always we are calculating what? Current cost. Current cost means what? We have to use current price. Then what? Par value is only used to calculate preferred dividend. See? Par value times dividend rate. But when you calculate the cost of preferred stock, you have to use this current price. But you have to also subtract what? Flotation cost, so that there is something you have to pay attention. Yeah, so we have 9% cost of capital. Then if there are two ways of expressing flotation cost. So you have to make sure that you do this one, same thing, the same question, except flotation cost is, let's say, 10%. Now, flotation cost is given as percentage. Then the formula is, it's not like that. Formula is RP equals DP over price, today's price times 1 minus F. So PN is the two ways of calculating PN. So P, net issuing price, is P0 minus F, or PN is P0 times. So I have a small f using percentage flotation cost, big F as dollar, right? Two ways, right? Two ways of expressing net issuing price. So just use this one. Then what?
Wait,
Then we,
you said that the big F was expressing what and the little f was expressing what?
good question. Big F is dollar cost. Yeah, dollar cost, right?
Uh-huh.
And small f is percentage cost.
Got it. Okay.
Thank you for asking. Okay, so that helps other people. Yeah. So question is not only good for you, but also good for other people. So now TP is same question. So TP is 10, and P0 is 113.10. But 1 minus 0.1, right? So using our technology, 113.1 times 1 minus 0.1 is 0.9. 0.9 equals 101.79. So 10 over 101.79. But as I said, don't enter this one yourself. Just use this number on the screen directly and divide by 10. Then this is inverse of the answer, so 1 over x. Use 1 over x. 0.10, that's not 10%. So you have to, so if you carry two decimals, always multiply 100 to get percentage. So 9.82%. 9.82%. Very, very important, 9.82%. So always show me two decimals, 9.82%. Okay. So the two kinds, so you should be able to do both, right? So this is when flotation cost is given as dollar, right? Then just P0 minus F, flotation cost. Flotation cost is given as percentage, then just 1 minus 0.1. P0 times 1 minus F, right? So that's how to calculate the cost of preferred stock. Then flotation costs are cost for preferreds are significant, so we reflect that one. So use net price. Preferred dividends are not tax deductible, so no tax adjustment, just RP. Same thing, nominal RP is used because we have quarterly dividend, but we didn't just get effective rate, just nominal rate. Same reasoning with this. Cash flow, so the reason we calculate cost capital is what? To evaluate projects. But when we evaluate project, we have a cash flow at the end of the year like this. So if you use effective rate, then it's discounting too much. So we just use nominal rate. So that is cost of flotation cost. I mean, cost of preferred stock. So far, so good, because it's pretty simple. The formula is just one. But now, this is the most important. What is how to calculate common equity? Then what are the two ways that company can raise common equity, so simply issuing new shares, right? Or just by reinvesting earnings that are not paid out as dividend, right? That is what? Retained earnings, retained earnings. Then what? Retained earnings or reinvested earnings. Why is there a cost? Because this is your money. It's yours, right? Is there a cost? So you made earnings, right? It's your money. Is there cost for your money?
Capital gains or costs?
That's related. Yeah, that's related. More direct answer. The answer is opportunity cost. Why there is a cost for reinvest earnings? Earnings can be reinvested or paid out as dividends. So investors could buy other securities and they can earn a return, right? So there is an opportunity cost if earnings are reinvested. In other words, it's your money, but you have to generate some return to satisfy your shareholders. The shareholders still require some return for that retained earnings. So investors require the return. That is opportunity cost. Okay, you have to generate the return. So that is opportunity cost. So that is the cost. So opportunity cost is what? The return stockholders could earn on alternative investment of equal risk. So you have to provide them the return. If not, investors may just sell the stock and don't invest money to your company. So that's the opportunity cost. So same risk class and same kind of nature of business, whatever. So some similar companies return. That is what? That is opportunity cost. So like they could buy similar stocks and earn RS. RS what? Cost of, S stands for stock or equity. So that is cost of equity, RS. Again, that is RS is normally return on equity, okay? Return on investment on stocks. But as I said, now investors' return is your cost. You have to give them this return to get their money. So this is now cost. Or company could repurchase its own stock and earn RS. So RS is the cost of invest earnings, and it is the cost of equity. So even though retained earnings is your money, but there is cost, opportunity cost. So you have to generate the return investors require. So that is why there is cost even your own money. Then there are three ways to determine cost of equity. So cost of equity determination is difficult. Cost of debt, cost of preferred stock, we have just one way, but it's not easy. So there are three ways. CAPM way from chapter 2 or from 3 or 4, capital asset pricing model, CAPM. Then return is risk-free rate plus market risk premium or risk premium for the market, right? RPM or MRP, same thing, market risk premium, right? Market risk premium is what? Market return minus RF is risk-free rate, right? RF is So RM is market return. M stands for market return. And RF is risk-free rate, right? So RM minus RF is market risk premium. Times B is what? Beta, right? So that is how to calculate return. But as I said, return becomes cost for financial managers to get their money. So we have to calculate RF and RM minus RF and beta and just use this formula. So in this case, this is how to calculate cost of equity. Investors' return is financial manager's cost. And this is generally the best because it's modern finance, right? But what do you think is DCF? Wheel of Fortune, DCF.
Discounted cash flow?
Check. Good guess. Discounted. And CF means cash flow. Just cash flow. Discounted cash flow model. And look at this formula. And this formula is actually from common stock valuation, right? So it's like this. Constant growth in dividends. Common stock valuation. Anybody remember price today is what? Actually, this is constant growth, so this is growing perpetuity. Growing perpetuity formula is payment 1 over I minus G, right? Do you remember that? Payment over I minus G. But now, this is a stock, so instead of payment, you have dividend. D means dividend. 1. Instead of I, you have RS, return. Generally, it's not just interest, it's return. Minus G is growth rate, right? So that is from constant growth stock valuation. And then what? Then you have RS, that is cost of equity. So you can get RS from this equation. Then what? From P0 times RS minus G is what? That is D1, right? P0 times RS minus G is D1. Then what? Then you can just expand this one, P0 times RS minus P0 times G is D1. Now solving for RS, so you move P0 times G the other side. So P0 times RS is D1 plus P0 times G. To get RS, you divide each side by P0, right? So RS is D1 over P0 plus P0G over P0G. P0 times G over P0 is G, right? So that is actually, as you know, nothing more than constant growth common stock valuation formula. And that is this, see, D1 over P0 plus G. So that is from constant growth common stock valuation formula.
Can you go back to that slide really quick?
Oh, sure, like this.
Yeah, I just want to finish copying it.
Just let me know.
Okay.
Okay, thank you. So then what? So this one is just from constant growth common stock valuation. So we know the limitation. So this formula is for more mature companies. So growth is stable, something like that. If not, this may not be good for startup companies, right? Or some very irregular growth companies. So this one has, you know, that this one has some limitation. And finally, third way is, you know, which one is bigger, cost of equity or cost of debt?
Debt?
Wrong answer is better than no answer. Good participation. Then let me ask you this way. Which one is more risky, stock or bond?
Stop.
Stock. Yeah, stock is more risky, so stock should have bigger return, right? Risk premium case, more risk means what? More return, generally speaking, right? So stock is more risky, so stock return should be bigger than bond return. So, but which one is easier to calculate, stock return or bond return?
A bond return.
Bond.
Check. Yeah, bond return is one formula. We just calculated, right? That's easy. So we know that stock return is greater than bond return. So from here comes this formula. Stock return is bond return plus some risk premium. But this risk premium is equity risk premium. That means what? Equity value is greater than bond, equity return is greater than bond return, right? Because of risk. So you add some risk premium. But be careful, I have to put in different color. That is not, don't forget, that is not market risk premium. Equity risk premium is equity over your bond, your company bond. And this one is what? Market return over risk-free rate. It's totally different, so don't be confused, okay? Don't be confused. So there are three ways. So number three is just really understandable, just makes sense. Stock return is greater than bond return, but bond return is easy to calculate. So when you calculate bond return, add some risk premium, pretty simple. And CAPM model, modern finance, discount cash flow model is from constant growth, stock valuation. So given three ways, all you have to do is now plug in some numbers to calculate. So RS is what? RS is RF plus RM minus RF times beta. And look at this problem. RF is given, right? And beta is given. But look at this. RPM or MRP. Don't forget, this is not RM, right? Be careful. Market risk premium is not RM, right? There's risk premium on the market, right? So you have to make sure that that is this. RM minus RF. So put 6% just here. But in the exam, this is a really common mistake in the exam, or even homework. They mistook this one as RM. So 6 minus 7, then what? There's -1. That doesn't make sense, right? But some people do that, okay? Be careful. Again, I had to put it in red to warn. MRP is not RM. So in this case, according to this problem, then what is RM?
13.
Check, 13. Because it's like MRP is 6%, so MRP equals RM minus RRF, and that is 6%. Then what? RM is 6% plus RRF. RRF is 7%, so 6% plus 7%, 13%. So I can make this problem like, I can give you numbers like RF is 7%, RM is 13%, beta is 1.2. Same thing. Then what? If I give you RM, then what? You can use 13 minus 7 is 6. Same. But here, please pay attention, because many people miss this one. They just use, MRP or RPM, just think that is same as RM. That's wrong, right? Please make sure that you know the distinction. So that is easy. Just plug in the numbers. And we didn't talk about this one before, but now it's 404. You have to think about how to use CAPM. Then
Can you mute yourself?
Mute yourself, okay? Mute. I hear some people saying something, okay? So here, don't forget mute, and unless you talk something, okay? Only when you talk in class, right? In class, just unmute and then mute again. So, we have to think about market risk premium, right? How to calculate. And that is, most analysts use a rate of 5% to 6.5%. So we use market risk premium 5% to 6.5%. And most professors also agree that 5% to 6.5%. And then how about just beta? A beta estimate is pretty noisy. That means what? They have wide confidence interval. That means what? It is not easy to calculate correct beta, because sometimes beta calculation depends on the time interval you choose, or sometimes whether you use daily return or monthly return or weekly return, the beta may change. So you have to be very, very careful, okay? So that's the also problem of CAPM, okay? So it is, you have to be careful, so you should not pick some time period when the market is especially volatile and, just data can be strange, something like that. Then it's better for you to have just some good interval, right? So those ones are issues. Also, risk-free rate. Risk-free rate is usually we use risk-free rate, RRF, is used Treasury bond. Why? Because treasury bond is government bond. They pay you back. But you may use treasury note. Depends on the length of the project. Yeah. Believe it or not, actually CAPM model is just 1 year model. So really specific to CAPM is actually treasury bill. Yeah, treasury bill is, but generally speaking, we are not examining 1 year project. Generally, the project is multi-year, so generally we use treasury bond. Those are some issues, right? And then how about DCF model? DCF model is just plug in the numbers. D0 is, let's say, $4.19, the dividend zero, right? Current dividend. And price $50, growth rate 5%. Then you have to know this formula and be careful. That is what? It is T1, right? Growing perpetuity formula is numerator is payment 1. So one year, just end of year, or cash flow because end of the year, right? So first payment is actually D1 or payment 1. But you know today's dividend, right? D0. So usually D0 is given, right? Then what? D1 is D0 times 1 plus G, growth rate 5%. D0 times 1 plus G, over P0 plus G. So you have to know the formula, this formula. Then what? Now you plug in the numbers. 4.19 times 1.05 over 50 plus 0.05. You know, this is 404 class, so probably you don't make mistake, but sometimes some people make mistakes, so I'll show you this one, right? 4.19 times 1.05, 4.40, right? Divide by 50.09. And some people, you may not believe, but some people just, according to formula, plus G. So G is 5%, so they plus 5, then what? 5.9%. That's wrong, right? So be careful. In the formula, you have to use real number. So subtract 5. Then what? 0.09 plus 0.05, then 0.14. But as I said, you have to multiply that by 100, 13.80. Or precisely 13.80%. Yeah, we so far we are using 2 decimals, right? So it more precisely, we have to here we have to enter 13.80%, right? So that is better. Yeah. So I told you that you have to give you 2 decimals, 13.80%. So that is the answer, right? 13.80%. Just plug the numbers. Okay, then next is, then for you to use this formula, you have to know the growth rate, right? Then how to estimate the growth rate. Then first thing is use the historical growth rate if you believe the future will be like the past. And then how to do that is like this. That is using the number is like this. Let's say you have the data, the past historical growth is that 2015 dividend is $3.5. 2016, $3.8. 2017, $4. 2018, $4.5. 2019, $4.6. 2020, $5. So let's say you have this data, right? Then how would you calculate growth rate? Anybody? Oh, by the way, today's quiz is on 4:30. 4:30, so please let me know it. 4:29. You should remember 4:29. 4:30, yeah, 4:30. So starting from 4:30, so 4:29. Anybody?
Would you just take the average of them?
Oh, that's a good answer is correct, but more specifically how?
Take the weighted average of the past 5 years.
Weighted average. So how? So yeah, so that is kind of general statement. So more specifically how you want to do it. Hint is using time value of money knowledge. So you know a lot, but the important thing is how you apply your knowledge, right? Actually, this one, you just calculate the growth rate. That is what? Then 2015, and that should, one has to be negative. So 3.5 is the present value, and 5 is future value. Now, how many years? How many years?
6 years.
Actually, this one is not like F. Actually, you need some period. So 1, 2, 3, 4, 5. Just 2020 minus 15. So 5 and so for IY. So second clear TV. 3.5 negative present value. 5 future value. 5 and in compute IY. 7.39%. So in this case, you just estimate growth rate as 7.39%. So that is how to use historical data, okay? Or you can just obtain analyst estimate like Value Line, Yahoo Finance. That's another way. Or you can use earnings retention model, and there is this earnings retention model. So let's say, suppose the company has been earning 15% on equity, ROE is 15%, and retaining 35%, and dividend payout ratio is 65%, and this situation is expected to continue, then what is the expected future growth rate? G stands for growth. Then you have earnings retention model. That is retention growth rate. G is ROE times retention rate. So how much you retain will contribute to how much you grow, right? So ROE times 1 minus payout ratio, retention rate, then 5.25%. This is close to G is 5% given earlier. So this is, so actually you use several methods and try to come up with some common growth rate for your real life application. Case 404, we have to think about how to actually use those formulas. Okay, so how to get G. So growth rate, I show you 3 ways. Then you may just do all 3 ways and try to come up with common number and some reasonable numbers. Again, finance is in management class. You have to use your discretion, okay, your experience. So in this case, we have to adjust 3 ways, but don't think about this number. This number is just I made up for you to teach this one. So don't pay attention to this specific number, right? But that number is based on this data, right? So just if all the numbers from 3 ways are close each other, then what? Then you have more confidence. You have more confidence. If not, you have to examine further and which one apply more for your company. Yeah. So then what? Choose the number accordingly. Then what? Finally, your own bond yield plus risk premium approach. Then what? Then risk premium should be given in the exam or quiz. But what? In real life, risk premium is, I'm using more general, more inclusive, so 2% to 6% like this. Again, so you have to use your discretion, okay? For example, your company is pretty stable company, less risky, then you may want a risk premium close to 2%. Or your company is very risky and highly volatile sales and so on, then you may want a number close to 6%. So it all depends on you. In real life, in the exam or homework or quizzes, that RP is given. But again, this RP is not CAPM MRP, so be careful. This is risk premium on equity, okay, of equity. So that is equity return over your bond return, and your bond is not risk-free, right? So CAPM MRP is what? Return on the market minus risk-free rate. But this RP is not return on the market, return on your company stock minus your bond, right? So it's totally different. So, but this is given, so 10% plus 4%, 14%, and produces ballpark estimate of RS. Then what? Useful check, that means what? You use this number as a useful check for checking CAPM answer and DCF answer, right? Whether those numbers are reasonable, because you know all these 10%, so your RS should be greater than that, but you use your CAPM, and so whatever the reason, RS is less than 10, like 9.5%, then what? Something's wrong, right? Definitely. So that's why it's useful check. Or, the range is from 2% to 6%. So the reasonable range is what? 10 plus 2, RD plus RP. Your RS reasonable range is 10 plus 6. So fall between 12 and 16%, right? But no matter what the reason is, your RS from DCF model, it is 18%. Then what? That's too high, right? Something's wrong. So that's why this formula is kind of useful check. You see whether the number from CAPM or DCF is reasonable. As long as the numbers are reasonable, then what? Then you put more weight to CAPM, is modern finance, and then the weight should be CAPM, DCF, then sum to bond yield plus risk premium or none, because they are just useful check. So all depends. That's why is again, management, your discretion. But here we just use simple average because what? Look at the numbers. Please close each other. The difference is less than 1%, right? Less than 1% difference. $14.2. So only the maximum is what? 0.4%. So it's not very big. So in that case, just simple average, that's fine. But in real life, it's better for you to have a weighted average, right? So if estimate from CAPM, DCF, and bond yield plus risk premium, 15%, 12%, 13%. And in this case, you use only 3%. Again, this is discretion, right? Then, based on your confidence in each method, RS can be, so if you put a lot of confidence on CAPM method, huge weight, and just next weight, and you don't give any weight to 13 because that is just useful check. There is no scientific just background. It's only just conceptual one. That is what cost of equity is greater than cost of debt. That concept. So 14.1%, or you can give more weight to CAPM, less weight to DCF, even less weight to BY plus RP. Or you have some similar weight to both and less weight on BY. In other words, if this is on the exam or quiz or homework, the answer is not just one. It depends on your judgment. But you have to make sure that, percentage of this PY plus RP are not big because they are just not scientific, and try to give, this is maximum, right? That is, CAPM has to be higher, right? So you can, the maximum is that both are the same, that's kind of maximum. But unless there is really special reason, this one cannot be less weight than this one, right? But that is general speaking. But as I said, if different color, if CAPM is, let's say, whatever the reason, 18%, and this is 14%, and this is 13%, let's say, right? 13% is there, right? then CAPM number is what? Way out of line, right? As you know here, if the range is like this, 18% is a lot higher than 16%. But if you have that number and if you give more weight on here, then that means you don't understand what's going on. Then that's the wrong answer. But if this is like 15, 12, 13, then all three methods, you get full point, right? It just depends on your confidence, which one you put more weight, right? Which one you put more weight. So again, so that's why finance is in management class. You have to use your judgment based on your company situation and based on your confidence on each method and based on your judgment of applicability of each method to your company. Yeah, something like that. So if the weights are reasonable, then what? Then full point. So that is how to calculate cost of equity. The most important cost of equity, right? Not easy. Even other cost of debt, cost of preferred stock, that's one way. But this one, three ways, that means what? It's difficult. So we use how to determine. Then now we calculate cost of debt and cost of preferred stock and cost of equity. Three kinds of capital. But when you calculate cost of capital for your company, you have to have one cost of capital, right, to evaluate project. Then how would you get one cost of capital when you have three components, right? That is famous WACC, weighted average cost of capital.
Professor,
So,
what does mean BY plus RP?
good question. You forgot. BY plus RP is this one. Your own bond yield, right?
Okay.
BY. Oh, that's a really good question. Yeah, actually I didn't specify. Yeah, bond yield plus RP, right? Good question. Yeah, that's a really clarifying question. Bond yield, BY. Your own bond yield plus RP. Good.
And how did you came up with this estimates 0.7, 0.5, 0.4?
Oh, again, that is your own judgment.
Oh, okay.
Those are your own judgment. Yeah.
Thank you.
Yeah. Good question. Yeah, that's the key point. And then how to determine the weights for WACC. So the weights in the WACC are the percentages of firm that will be financed by each component. Huh?
What time is the quiz today? It's 4:23.
Oh, quiz is 4:30, so tell me at 4:29. Thank you, 4:29. So 4 more minutes. So here, the weights are the percentages of the firm that will be financed by each component. So let's say, how much debt is used in your capital? How much preferred stock is used? How much common equity is used, right? So that makes sense. In other words, the more amount of each capital you use, the more the WACC is affected, right? For example, if you don't borrow money, if you don't issue preferred stock, if you have 100% equity company, then what? It's 100%. Then cost of capital is cost of equity, right? In other words, your cost of capital depends on how much of each component you use. So that is the weight. If possible, always use the, look at this red one, target weights for the percentage of the firm that will be financed. So in other words, target weight is your optimal capital structure that makes your stock price the highest. So what? Your stock price is the highest given that optimal capital structure. So even though your current capital structure is not optimal or not at the target, you use target capital structure because what? That is your target. You are shooting for that direction. You're going for that direction. So that's usually the weight you use, but that's very difficult, right? How to calculate. We'll do that in the chapter 15 and 16, optimal capital structure, but that's not easy. So if you don't know the target, then it is better to estimate the weight using current market values rather than current book values, right? So book value, don't use book value, but market value. But if you don't know the market value of debt, then it's usually reasonable to use book value of debt, especially the debt is short term. That is what. If it is short term, then book value and market value is not that difficult, not that different, right? So in that case, you can just use book value of debt. Then how to calculate weight is like this. We use market value. So suppose the stock price is 50. There are 3 million shares of stock. The firm has 25 million preferred stock and 75 million debt. Then what? And we just took those two as given. Then what? Market value of equity is what? 50 times 3 million. So equity part 50 times 3 million. What? 150 million. So 150 million. And let's say those two are just given as the market value. Then what? Total value is 250 million. Then how to calculate weight is what? 150 over total, 0.6. Preferred C is common equity, preferred stock, and debt.
It's
0.6,
29, Professor.
Oh, thank you. Thank you for big participation. Then we'll stop here. And then new fund. What's it?